Let's turn to the evidence on whether the market is semi-strong form efficient. In this section, I discuss semi-strong form efficiency in the share market. It is clear that the share market is at least weak form efficient. Investors do not earn positive abnormal returns by trading merely on the basis of past price and volume information. And it's clear that the share market is not strong form efficient. If investors were able to replicate the trades of investors with inside information, those investors would earn positive abnormal returns. What is debatable is the extent to which the share market is semi-strong form efficient. Do not fall into the trap of debating whether the share market is efficient or is not efficient. These black and white labels are unhelpful and distracting. The issue is how efficient is the share market in terms of investors' ability to use publicly available information to produce abnormal returns on a persistent basis. There are three key pieces of evidence in support of the argument that the share market has a high degree of efficiency. And recall that if the market is efficient, then you wouldn't be able to earn abnormal returns by trading on the basis of publicly available information. First of all, analysing past accounting information on its own doesn't work. Investors are unable to earn abnormal returns merely by analysing simple financial ratios based upon prices and historical accounting information. There is stock evidence that stocks with particular characteristics earn above average returns. This includes the evidence that stocks with low prices relative to past earnings per share, which we call low PE stocks, stocks with high book values of equity versus their market value of equity, which we label high book to market stocks, and stocks with low market capitalisation, which we can call small stocks, earn higher returns on average than stocks with different characteristics. But stocks with these characteristics also have above average risk. They are relatively more likely to become financially distressed. They have below average liquidity. The quality of information disseminated from these companies and analysts covering those companies is below average. And those companies have reduced ability to disinvest assets in a downturn. Once we account for the risk associated with buying stocks with low prices compared to past accounting information, the returns are normal compensation for risk. This doesn't mean that all analysis of accounting information is useless. If an investor is able to make better estimates of future earnings than other investors, this information can be used to earn positive abnormal returns. And the estimates of future earnings can in turn be informed by analysis of past accounting information. But the key part of that investment strategy is the ability to make better predictions of future earnings per share. It is not a case of simply buying stocks with low prices compared to last year's earnings per share, or the current book value of equity, or just low market capitalisation. Secondly, following equity analyst recommendations doesn't work. Equity research analysts make recommendations using language particular to their firms. For instance, one firm might use the term buy, while another firm might use the term outperform. Both labels mean that the analyst believes that this particular stock will earn high returns compared to a benchmark with about the same level of risk. For instance, the benchmark could be other stocks in the same industry or a market index like the S&P 500. Data providers aggregate the information used by equity analysts and standardise them, typically on a 5-point scale. For example, strong buy, hold, sell and strong sell. If an investor forms a portfolio which is long stocks with the most optimistic recommendations and short stocks with the most pessimistic recommendations, that portfolio performs better than a benchmark portfolio of stocks with similar characteristics in terms of market capitalisation and book-to-market ratio. This result holds even if you screen the analysts on the basis of who made accurate recommendations last year, or who made accurate earnings per share forecasts last year. The following two research papers are informative. First of all, we have evidence that you can beat the market by following the recommendations of analysts who you know will make accurate earnings forecasts. Researchers split equity research analysts into two groups, those who made the most accurate earnings forecasts and those who made the least accurate earnings forecasts. The researchers formed portfolios that were long the stocks recommended by the most accurate earnings forecasters and short the stocks the most accurate earnings forecasters said to sell. The researchers then took the opposite position for the analysts with the least accurate earnings forecasts. The researchers found that if you trade in a manner consistent with the recommendations of the most accurate earnings forecasters and trade in a manner opposite to the recommendations of the least accurate earnings forecasters, you could have earned positive abnormal returns. But wait, there is a catch. To form this portfolio, you would have needed to know which analysts were going to make the accurate earnings forecasts. And you don't know that information until the actual earnings are released by the company. To actually earn the positive abnormal returns, you need some way of predicting which analysts are going to make accurate earnings forecasts next year. Let's see whether this prediction can be made on the basis of past accuracy. Turns out that you can't make that prediction. You can't determine which analysts will make accurate earnings forecasts on the basis of their track record. What if you form portfolios on the basis of the recommendations of the analysts who made the most accurate earnings forecasts last year? This portfolio does not beat the market. Even if you identify the subset of analysts with the most accurate earnings forecast last year and who made the most profitable recommendations last year and follow their recommendations, this portfolio does not beat the market. The reason this strategy doesn't work is that there is too little persistence in analysts' ability to forecast earnings. Suppose you want to form a research team of 33 analysts from an initial cohort of 100 analysts. You scrutinise their track record of earnings forecast accuracy and recommendation profitability and select the all-star group of 33 analysts. You could call the low-ranked group of 33 analysts the underperformers and the middle group of 34 analysts the also-rans. If performance is random, you would expect about 11 analysts to remain in the all-star team next year. That is, 1/3 of the all-stars would be all-stars again just by accident. And if analysts exhibit persistence in earnings forecast accuracy, we would expect 12 or more analysts to be in the all-star team a second time. An alternative approach to assigning analysts to teams is to randomly assign analysts. The result is that the careful selection of analysts on the basis of their track record leads to just one better selection on the all-star team compared to a random selection. It is equivalent to paying millions of dollars to select the highest rated football players on a football team versus saving all the money and just losing one high quality player out of 30 on the basis of a random selection. Analysts still have an important role. The evidence suggests that identifying which analysts will make accurate earnings forecasts and recommendations cannot be done on the basis of their past track records. But analysts do things other than just make stock recommendations. They have an important job. Portfolio managers hold well-diversified portfolios of around 30 to 200 stocks. And those portfolio managers are not typically specialists in particular industries. To have a team of industry specialists is expensive because the firm needs to hire more portfolio managers so that each manager can devote more time to each individual investment in an industry. In contrast, equity research analysts typically cover a relatively small number of stocks in a particular industry. The detailed industry and company-specific information disseminated by these analysts provides useful information to portfolio managers. Portfolio managers do not mechanically follow the recommendation of equity research analysts. They know the results we've just discussed, either from direct reading of the research or from their observations in practice. But portfolio managers are interested in why different research analysts form different opinions on earnings forecasts, price targets and recommendations. The conversations, presentations, reports and data supplied by equity research analysts can be useful to a portfolio manager with skill in converting this information into investment decisions. The key point is that the analyst's role is not to sit in isolation and compile three metrics: earnings forecasts, price targets and recommendations. As researchers, we've examined these outputs in depth because it's easy for us to analyse that type of data. The analyst's role is to provide information to portfolio managers to make investment decisions, and the information provided to portfolio managers is much richer than just these three metrics. The next piece of evidence against market efficiency is that there is weak persistence in the performance of the returns earned by mutual fund managers. A key word in the introduction to market efficiency from a few moments ago is persistence. To claim the share market is inefficient, we need evidence that there is a subset of investors who are able to earn positive abnormal returns on a persistent basis. And this subset of investors must be larger than we would expect purely by chance. For example, we could rank investors from 1 to 100 on the basis of last year's return and label them as winners versus losers on a 50-50 split. If performance is random, we would expect 25 winners to be winners a second time around and 25 winners in year 1 to lose in year 2. In sum, random performance means 25 repeat winners, 25 repeat losers, and 50 investors have a 1-1 win-loss record. The researcher examined the performance of mutual fund managers and found that there was some persistence in mutual fund performance, but that it was only slightly better than what would be expected by chance, and most prevalent amongst poorly performing managers. That is, losers are relatively more likely to repeat their poor performance compared to winners repeating good performance. Another important result is that the fees charged by mutual fund managers are not indicative of performance. Most of the time, price is directionally consistent with quality. A 2,000-foot house costs more than a 1,000-square-foot house. A tailored suit costs more than a suit off the rack. A steak dinner at a nice restaurant is better than a chain restaurant meal. For the record, the area of my apartment is 700 square feet. My suits are from Macy's, and I eat regularly at Denny's. Saying that prices are directionally consistent with quality does not mean that paying high prices or low prices is better or worse. There are exceptions. There are large but poor quality houses. There are high quality ready-to-wear suits, and you can have a disappointing but expensive meal. But on average, high price implies better. This is not the case for mutual fund fees. Researchers have not been able to identify a positive association between fees and performance. The evidence suggests that fees are more likely to be a function of marketing than performance. However, there is a clear relationship between performance and fund flows, which are the dollars flowing into mutual funds. Money does follow performance, which tells us that mutual fund investors pay attention to past returns. But this performance has little persistence, so the mutual fund investors are chasing returns rather than being able to predict which mutual fund will earn higher returns next year. What about the evidence against market efficiency though? The evidence in the prior section is that the share market exhibits some degree of efficiency because 1, investors cannot beat the market by simple analysis of prices compared to historical accounting information. 2, investors cannot beat the market by following the recommendations of equity research analysts. And 3, there is weak persistence in the performance of mutual fund managers. However, there is evidence that adopting a disciplined, sophisticated investment strategy can lead to positive abnormal returns. For this result to hold, in conjunction with the result for mutual fund managers, it must be that few mutual fund managers, in fact, adopt a disciplined, sophisticated investment strategy. It could be the case that mutual fund managers are overly influenced by short-term information. So they have behavioural biases that outweigh their investment skill, or that they aren't patient enough, or they're underlying mutual investors. Mutual fund investors, they're not patient enough to beat the market on a long-term basis. Alternatively, some researchers believe that the forthcoming results are mere artefacts of analysis of past data and so won't be repeated. You will ultimately need to form your own opinion as to the degree to which the share market is efficient or inefficient. My own view is that there are inefficiencies that can be exploited by investors who incorporate a disciplined and sophisticated investment strategy and are able to execute their strategy with a 3-year horizon. Most investment strategies don't earn positive abnormal returns every single year. This view is consistent with the evidence that private equity managers earn higher returns than the S&P 500. In private equity, there's more advantage to compiling and analysing information, and this is reflected in higher returns. Private equity also exposes investors to illiquidity risk, but annual private equity fund returns are around 4% above the returns from buying publicly traded stocks, which more than compensates for a lack of liquidity. Now, my view is not fact. It is an interpretation of the evidence, and ultimately, as researchers and practitioners, we should reach conclusions from the evidence. So let's consider the first piece of evidence against market efficiency: buying stocks with large positive earnings surprise. The researchers compiled earnings surprise data. They compared actual earnings per share to the average analyst forecast for earnings per share. Positive surprise means that actual earnings per share was above analyst expectations. Negative surprise means that earnings per share was below analyst expectations. The researchers scaled earnings surprise by price and ranked stocks from highest to lowest earnings per share, scaled by price. The researchers found that if investors buy stocks in the highest decile of earnings surprise and short sell stocks in the lowest decile of earnings surprise, this portfolio earns positive abnormal returns over a subsequent 3-year period. Note, however, that stocks in these two deciles are typically smaller, less liquid stocks than stocks and have less analyst coverage than other stocks. The opportunity to form a portfolio that beats the market exists because the stocks with these characteristics, less analyst coverage, less liquid stocks, smaller companies, they have less trading amongst well-informed investors. Second piece of evidence is that buying stocks after a takeover announcement on that stock is profitable. This strategy is called merger arbitrage. When there is an announcement of a merger or takeover, the target company's share price will typically jump by around 30 or 40%. But even if you buy the target company's shares after this initial positive price reaction, your portfolio on average will earn positive abnormal returns. The label merger arbitrage is not correct because the term arbitrage means an investment with a risk-free positive payoff and no upfront cost. The merger arbitrage strategy generates a positive return most of the time rather than a guaranteed return, hence the use of fairly loosely of the label arbitrage. The reason the strategy on average earns positive abnormal returns is that there are enough instances in which there is a subsequent higher offer for the target stock, leading to a further price increase, or the initial price increase is below the initial offer on the basis that the initial price reaction incorporates some chance the deal is going to fall through and that the share price might fall back to its original level. Investors with risk tolerance which is moderate For example, a pension fund or mutual fund will sell after the initial positive reaction because there is a small upside most of the time, but a large downside some of the time. In contrast, investors with high risk tolerance, for example, a hedge fund, will buy the stock, often with borrowed money, to profit from the small increase in price after the deal. And this occurs most of the time. Most deals eventually go through. The buyers may even have skill in identifying which particular deals are more likely to proceed than others. Why does this opportunity exist? Why is the potential future upside not reflected in the initial price reaction of 30 or 40%, given that this trading strategy of merger arbitrage is well known? The answer is risk and a segmented market. This is not a guaranteed return, it's a risky bet, because the target company's share price could fall back to its pre-announcement price, leaving the buyer with substantial losses, especially if borrowed money is used to make the investment. Not all investors have the willingness or the liquidity to take on that risk. Only a subset of investors have the risk tolerance and liquidity to execute this trade on a repeated basis. Third, let's consider buying stocks for which a company has announced a share repurchase. Suppose a company announces it will repurchase its own shares. This announcement will, on average, trigger a positive share price reaction on the day of the announcement. The reason the market considers this good news is that it signals executives' confidence in future earnings prospects, or signals investors' belief that the shares in the company are being priced too low by the market. Researchers have found that executives have market timing skill in relation to stock in the company they work for, but they do not exhibit market timing skills generally outside that company. And this is likely due to executives' information about future earnings that the market has not fully accounted for in the current share price. Now, it doesn't necessarily mean that executives have held price-sensitive information back from the market. It simply means that the market may have formed a less optimistic view on the company's prospects than the company insiders. The trading strategy is to buy shares in the company after the repurchase announcement. Just like with the earnings surprise strategy or the merger arbitrage strategy, the investor will buy shares after the initial positive price reaction. But on average, the share price continues to increase after that initial price reaction. Finally, in terms of evidence against market efficiency, let's consider the strategy of selling stocks for which the company has announced it will issue new equity. A seasoned equity offer is an offer to sell new shares by a company that is already listed. This can be contrasted with an initial public offer, or IPO, which is the first sale of shares on the public markets by a private company. Research shows that if you sell stocks in companies after the company's announced seasoned equity offerings, this portfolio will earn positive abnormal returns in the subsequent 3 years. As with the other three strategies, this opportunity exists because of an underreaction by the market to an announcement of a seasoned equity offer. The typical reaction to the announcement of the share sale is negative, because it often signals that the company has an unanticipated need for cash. Issuing new shares is not necessarily bad news. The company could be raising capital for a positive net present value project. But on average, the market is disappointed by these announcements. The long-term result shows that on average, the market is not disappointed enough because of the subsequent underperformance. So we've got some evidence in favour of the argument that share markets are efficient. We've got some evidence against the idea that share markets are efficient. Let's consider where portfolio managers might be able to earn abnormal returns if they can execute a disciplined and sophisticated investment strategy. The evidence shows that mutual funds exhibit weak persistence in performance. But mutual fund managers do not constitute the full suite of portfolio managers. There's endowment funds, there's insurance companies, there's hedge funds. Mutual funds is just a subset of all these institutional investors. And the ongoing willingness of investors to allocate funds to active managers suggests that at least some active portfolio managers earn persistently high returns. Private equity portfolio managers in particular, as we've mentioned, earn high returns, and they show more persistence than portfolio managers investing in publicly traded stocks. It could be the case that most portfolio managers who market themselves as active managers just have too much weight in their portfolios in the most active, largest shares, like Apple, Facebook, Netflix, and so on, for their active management skill to actually have a meaningful or noticeable impact on portfolio performance. So researchers have asked the question as to which parts of the portfolio formation process are most likely to lead to outperformance. This helps us understand if it is possible for an active manager to beat the market, which portfolios are most likely to do so on the basis of their stated portfolio management process. Let's consider benchmarking. A portfolio manager's benchmark could be formed on the basis of asset classes. For example, stocks is an asset class and bonds is an asset class. So a benchmark asset class weight could be 60% stocks and 40% bonds. Within asset classes, there could be industry sector weights. For example, the benchmark industry sector weight might be 20% information technology, 16% healthcare, 14% financials, and so on. And finally, within industry sectors, each stock could have a benchmark weight. For example, within information technology, the benchmark weight could be 21% Microsoft, 19% Apple, 6% Visa, and so on. The question is, if we compare a portfolio manager's overall performance versus a benchmark, of the managers that do beat their benchmark, do they win on the basis of asset allocation, shifting their portfolio weights between asset classes, for example, taking an overweight position in stocks versus benchmark because the portfolio manager believes that stocks will perform well next year and therefore taking an underweight position in bonds? Do some managers win on the basis of their industry sector allocation, for example, shifting their portfolio weights between industries, like taking an overweight position in technology and an underweight position in healthcare? Or do managers that do beat their benchmark do so on the basis of individual stock selection? For example, taking an overweight position in a particular stock, like going overweight Microsoft and underweight Apple. The answer is that of the portfolio managers that do earn positive abnormal returns, they primarily generate those returns from selection of individual assets and not by attempting to deviate from benchmark weights in terms of asset allocation or industry sector allocation. Now, there's more money to be made by a portfolio manager who can time the entry into stocks versus bonds as an asset class, and more money to be made by a portfolio manager who can pick which industries will outperform next year. But there are just very few portfolio managers who exhibit this market timing ability. The aggregate share in bond markets and the industry sectors seem to be too efficiently priced for us to identify portfolio managers who can predict outcomes for entire asset classes or industry sectors. However, there is evidence that the portfolio managers who do beat their benchmarks do so on the basis of selection of individual stocks and bonds that earn high returns. This tells us that the market inefficiencies can be exploited provided the investment strategy entails reasonably detailed individual security decision making, as opposed to larger scale or broad brush attempts to pick asset class winners or industries next year. The last thing I want to talk about in this presentation is why there are constraints on exploiting inefficiencies to the point that they disappear. And there's 3 of these constraints which I believe lead to some deviation from efficiency. A common objection to the argument that the share market is not entirely efficient is that if investors could use publicly available information to beat the market, this trading activity itself would cause prices to shift towards fair prices. For an inefficiency to persist, there must be a market friction which impedes an immediate shift to fair prices. Now, this is one reason why I was so adamant in the earlier discussion that the market is at least weak form efficient. There's no market friction that impedes investors from analysing past share prices and volume, making trades and therefore pushing prices to the point that prices already incorporate past information on prices and volumes. But in relation to the trading strategies discussed above, there are plausible market efficiencies that allow plausible market frictions that allow inefficiency to persist. First of all, there's costly information. Exploiting market efficiencies requires information. For example, the strategies based upon earnings surprise or merger, share repurchases and seasoned equity offerings rely upon gathering data and analysis that is beyond the scope of retail investors to exploit on a persistent basis, but can be exploited by institutions. Portfolio managers who perform intrinsic value estimates for individual securities devote time and money to data compilation, whether that is on a computer or on the ground. The costly acquisition of information reduces the number of investors who are able to exploit an inefficiency. As mentioned earlier, costly information search is one reason why private equity funds outperform the S&P 500. Secondly, we have incomplete markets. For prices to converge to efficient levels requires the ability to short sell and infinite liquidity. If optimistic investors can buy a stock, but pessimistic investors cannot short sell the stock, a price can remain above fair value for an indefinite period. Property prices can be inflated for an extended period because property is hard to short sell. And during the technology bubble of 2000, some companies changed their name to signal a technology focus. Researchers documented that on average there was a positive price reaction to the announcement of this name change, despite there being no genuine prospect that the companies had valuable technology. The immediate positive share price reaction was not followed by an immediate price decline, even though well-informed investors knew the positive price reaction didn't make sense. The explanation for this result is that the pessimistic views of informed investors could not be reflected in the share prices because of the limited ability to short sell. And finally, as a market friction which allows inefficiency to persist, we have the lack of unlimited access to capital. Investing requires capital, and the providers of capital do not have infinite patience. When an inefficiency is present, prices can deviate from fair value for a long period of time. If prices have not converged to fair value before the patience of capital providers is exhausted, in short, if the money runs out or capital providers cannot bear risk any longer, the investor will need to close the position even if the trade would ultimately have been profitable. To understand capital risk, we turn to the biography Bringing Down the House by Ben Mesrich, published in 2002 and adapted in the 2008 movie 21. Students at MIT travel to Las Vegas to exploit an inefficiency in blackjack. Blackjack can be beaten by counting cards. In the high-low system, the player assigns a score of -1 to high cards, that is 10, Jack, Queen, King and Ace, and a score of +1 to low cards, 2 to 6. The player places low bets and keeps track of the aggregate count. When the count is high, it means there is a greater chance of consecutive high cards being dealt, which tilts the odds in the player's favour. So the player significantly increases the player's bet when the count is high. In summary, blackjack can be beaten by betting low when the odds are in the dealer's favour and betting high when the odds are in the player's favour. And on average, the bets will win. But it's a small shift in the odds. It goes from giving the dealer a marginal benefit to giving the player a marginal positive benefit. For the MIT students, they need to play in teams because card counting is easy to spot when an individual is counting. Why would the player bet $10 hand after hand and then suddenly bet $1,000? So the MIT students have a player bet the minimum until the count is high and then signal to another player to sit at the table and place large bets. Is there an inefficiency? Yes. Blackjack can be beaten, but that doesn't mean that there is no risk. The player can win on average, but lose a large amount of money very quickly. If the player runs out of cash before there are enough hands for the average result to hold, then the loss can be very large. Of course, the MIT students also face non-liquidity risk from the casinos, but I will leave it to you to read the book to appreciate those risks. The investment strategies described earlier generate positive abnormal returns over periods of 1 to 3 years. But in the meantime, the losses could be large, and the lack of unlimited access to capital allows inefficiencies to persist. Let me make the following concluding comment. If you want to demonstrate your ability as a portfolio manager, that you can earn abnormal returns. A theoretical reason why the market has ignored the information the portfolio manager has uncovered. You've got to show information that's different to consensus. You've got to show that transaction costs are sufficiently low and liquidity sufficiently high that abnormal returns are not eroded by fees and risk. And you have to demonstrate an investment strategy that can be executed over and over again. This means the portfolio manager, in claiming that the manager can beat the market, can say, if I see this signal, I'm going to execute the following trade. If I see another signal, I'm going to execute the other trade. Put another way, if the portfolio manager tells me that the strategy simply reflects judgment or sentiment, but cannot say which judgment or sentiment the portfolio manager is referring to, or at what price you think an investment should be bought or sold, that's not a trading strategy. That's simply marketing. I hope this presentation on market efficiency was informative. I look forward to your upcoming questions.